Hi, everyone. It's Anthony Caparino here again. Welcome. Today, I am with Steve Kaplan, professor of entrepreneurship and finance at the University of Chicago Booth School of Business. Today, we're going to be talking about private equity, a little bit of its history, a little bit of its future, and some other areas of expertise that Steve has. So, Steve, welcome, and it's a pleasure to be here with you today.
Great to be here, Anthony.
And just as a backdrop for everyone, A&M is a proud sponsor of Universities of Chicago's private equity conference, which we're looking forward to here in the near term. So Steve has graciously agreed to join us today. So Steve, why don't we get into it? You've studied private equity for many years, and from your vantage point, how has the role of private equity in the economy changed from when you began studying it to now?
I mean, it started in the 80s as, financial engineering. It was, I would say, probably disproportionately public to private transactions. And it was focused on just leverage buyouts. And today it's just mushroomed to, all over the economy. You've got buyouts, you've got growth, venture capital is also increased in size, private credit, infrastructure. And so it's, I'd say broadened and deepened to the point where, you see various estimates of how big it is in the economy, but it's probably 10 to 20% of the economy, closer to 20, which is huge. So it's a big part of the economy, and I think, well, I'll stop there. So it's a much bigger part of the economy, and that's why it gets a lot of attention.
Yeah, I've been doing this work now for 25 years with private equity, mostly middle market private equity, but to your point, the fund sizes have grown. We've seen them be core US focused funds to now many of them being global funds.
Global as
Uh,
well,
industry
absolutely.
industry wise, perhaps focused on one or two industries, now many spanning multiple industries, anything from software to healthcare to everything in between, energy, all in one fund. So it's been fascinating over 25 years to see how that's migrated.
No,
And
that's
I think,
another good. It's another good point. Like in the sorry, I interrupted. In the
it's okay.
80s, it was really mature companies that were, needed, I think, some um, tightening up. And over time, it's morphed to, all parts of the economy. You're exactly right. Healthcare, software. There was no software back in the 80s and 90s, and that just took off. And healthcare has also taken off. So it is across a broader part of the economy, and they used to be very much cost cutting focused, and now it's sort of improving the business focus. But we'll talk about that, I think, in some of the next questions.
Sure. And you referenced how it started in the 80s, and there's been I'm sure, given your dealings with private equity, many lessons learned. One of the things that over the last number of years that's been quite clear is we operated in a zero interest environment for quite a long time. Now it's different. But if you were to think back on just lessons learned over your history here with private equity, what are some broad lessons learned around leverage, around incentives, around governance that you feel like people have taken away in general, but also maybe even your own studies? What have you learned around those areas?
There's been a real, I mean, evolution over time, and it's always, in a certain direction. So it started in the early 80s with financial engineering, and KKR, was probably the innovator there. And they figured out that if you leveraged a company appropriately, in the right industry, and you gave management incentives, that the companies would perform better. And that turns out to be true today. If you ask people, you ask the buyout investors, private equity investors, what's like the most important thing, they almost always say one of the most important things is giving incentives to management. So KKR figured that out. The leverage was, I don't know if you remember this, it was 90% in the 80s. It's bizarre, right? They used too much leverage. So that was one lesson learned. 90% leverage on companies is too much. And so, in a lot of those deals in the late 80s defaulted because what happened is everybody bought companies, leveraged them, gave management incentives, and they paid too high a price. All the gains went to the sellers, and a lot of those deals in the late 80s defaulted. So now you had to do something different in the 90s, and it kind of started then that you were going to use less leverage because the lenders are going to give you less. You still give management incentives, but then you got to figure out what else to do with the business. And so you've got the financial engineering, governance engineering. That's always been the case. The private equity investors pay attention to the governance of the company and are pushing hard on management. And then the operational engineering kind of evolved over time. So that's the evolution I'm talking about. People realize that to make excess returns, you couldn't just, buy a company and give incentives, because everyone was doing that. You had to do something different. And Bain Capital was one of the innovators there, using consulting to improve the companies. Clayton Dubilier was one of the innovators. They were really the first people to have operating executives. And this sort of evolved over the 90s and early 2000s. I mean, it was very interesting because KKR would not do this. They said, we're financial engineers. And then in the early 2000s, they realized we can't do this. We've got to do something different. Blackstone, the same, they started the operational engineering in the early 2000s. And in the 2000s, what you've seen is everybody today has moved to a model where we put the right capital structure on it, we give incentives, but then we have to do something on the operating side. And that's why, there are some healthcare focused funds, software focused funds. The big funds all are, verticalized, meaning they've got expertise in a particular industry. And so that's been the evolution. It's great because they create more value on the operating side. But now the challenge is going to be everybody's doing it. And will all the gains again go to the sellers because you're competing against other people who are doing the same thing?
Yeah, that's interesting. Part of how we formed our transaction business at A&M back in 2006 was exactly on that premise. You combine the accounting and financial expertise with A&M's operational heritage to bring that value proposition across the transaction lifecycle as firms started to focus more on the operational value creation. And, we've seen that over the last 20 years evolve. And I agree with you. There weren't a ton of firms back in 2006 doing it, but now pretty much almost every private equity firm has to focus on operations. And it will be interesting to see how that next wave of performance is generated in light of the fact that everyone's doing this now. The leverage markets ebb and flow, and now for many private equity professionals who only knew a zero interest rate environment for better part of almost 20 years, now it's a little bit of a different game. So how do you change that operational angle to really get a leg up versus your competitors?
No, it'd be very interesting. I would say so. So a couple of things. First of all, we've been private equity and buyouts have done fine in environments where interest rates were not zero, right? It's, prior to the great financial crisis, interest rates were, I think, kind of where they are now. In the 90s, they were actually, I think, higher. So interest rates move around. I think what happened here and was harmful is if you did a deal at a low interest rate and then they popped up,
Right.
all of a sudden you had a big headwind. If you do the deal today, where the interest rates are where they are, as long as interest rates don't pop up again, you're fine. And in fact, if they go down, you get a bit of a tailwind. So it really depends on where, what the delta is while you're in the deal. But people will do deals, given, the level of interest rates, I have no doubt they'll do the deals. Now, the question is, to your point, I'm competing against other guys who are doing and gals who are doing the operating stuff. I've got to be a little bit better than the other person in order to make money.
It's it's
But
very interesting to watch, and you look at private equity today, and then you've talked about now the performance over time. Your research really has focused on the fact that private equity returns on average are comparable or better to the public markets. And I know you've recently given a talk around how that was a statistic up until about 2019, and now over the last 6 or 7 years, there's been a bit of a change. Can you talk about that for a little bit? Just how the private equity returns have compared to public markets, and what maybe has changed a little bit over the last few years.
Okay, so here are the facts, and this uses data from MSCI Burgess, which probably has the best data set. Although, if you look at other data sets, you get pretty much the same result. And Adipar, which is very nice, has more family offices than institutional investors. You get virtually identical results. So here's how it looks. If you look at, and I like to look at vintage years rather than the returns each year, because the returns each year have like 10 vintages in them. So it's kind of a mishmash. Look at each vintage and say, okay, what if I put money in the median fund of that vintage or the average fund? The results are pretty much the same. If you look from 92 to 2018 or 19 vintages, so let's say 92 to 2018 for sure, there's like one or two vintages that did not outperform the S&P 500, meaning 92 to 2018 is what, 27 vintages. 25 or 26 outperform the S&P 500, which is like ridiculous, right? Yeah, and that's net of fees.
Right.
People say, oh, that's gross of fees. No, that's net of fees. So gross of fees, they crushed the S&P. Net of fees, they beat the S&P. So that's like an amazing fact. And that's why so much money, went into private equity. Then 2019 is about equally S&P 500, maybe a little below. 2020, 21, and 22 are below the S&P 500. So now you've got 3 or 4 vintages that are going to be S&P or below, and that's unusual. That's why there's some headwind into fundraising right now. That's why there's some headwind. The press will write negative articles about this. And the reason for that, of course, is the S&P 500 has been unbelievable, right? Because of the Magnificent Seven
Right.
tech.
Yep.
That's been a really, really tough benchmark. And so those are the facts. Now, what's interesting is if you take the Russell 2000 instead of the S&P 500, actually the more recent vintages are fine. They're actually outperforming the Russell. And if you look at 92 to 2022, so that's 31 vintages, there are again only 1 or 2 that underperform the Russell 2000. They're actually in the late 90s where they underperformed a little bit. So the Russell, which is probably the better analog than the S&P for buyout, because buyout doesn't have the a lot of mega cap.
Right.
Big deal is 25 billion, which is really mid cap, and then you got middle market, lower middle market is more like small cap. Small and mid cap, Russell 2000, you're outperforming. So the outperform depends on what you want to compare it to, as to how you think they're doing. But those are the facts, and those are like you'll hear some people say different things, but on buyout, those are the facts. I think if you go to real estate and infrastructure, those have underperformed the S&P 500 over time, over longer periods of time. But infrastructure and real estate, it's not clear the S&P 500 is the right benchmark at
Right.
all,
Right.
or even the Russell, because those are different things. But those have underperformed, and what you think that the stock markets, what you think of that, you know, whether you get diversification benefit out of that, you're not getting the returns on those. But on the
Mhm.
buyout side, which is really where I focus and where I think you focus,
Yes.
the facts are very good. And at the portfolio company level, the facts are also good in terms of value creation. Margins go up on average, productivity goes up. So, and that's gross, that's sort of gross of fees, right? On the operating side, the evidence is almost uniformly positive. And then that has translated into positive returns, except over the last, those 19 to
Right.
22 vintages, not on that versus the S&P 500.
Interesting. So maybe let's focus on the last 6 or 7 years. What makes it difficult to really pick a top quartile manager? Obviously, many funds have done well. The data will tell you, as you said, the last few years, it's been a bit more challenging, but what are some difficulties in really choosing those top quartile performers if you're an LP?
Okay, so now as an LP, again, this is the facts I gave you overall the median and average fund, right? So you didn't have to pick, right? That was the
Yeah.
great thing. You got you just threw darts and, and you did great. Um, Now, and not everybody can pick, so that's the a challenge. Now, what happens in the industry is super interesting, is the persistence, your ability, like if your strategy, which was the David Swensen strategy, was like pick the top quartile funds and invest in them. And that actually stopped working in the 2000s in buyout. It works in venture, but in buyout, if you look at sort of top quartile funds when they're fundraising, it's important when they're fundraising, or you look at, so take a fund that's fundraising, is it top quartile or not in their current fund, doesn't predict anything. And then you can say, is their previous fund top quartile or not? Doesn't predict anything. So the quartile stopped predicting. It did predict before, and when Swensen was starting in the 80s and 90s. So now it doesn't predict. Why doesn't it predict? I think there are two or three reasons. Number one, a lot of the good performers got very big, right? So if you had a very good fund like a Blackstone or Bain Capital or whatever, you got very big. And I think that made it harder to have good performance. Number two, if you didn't perform, you're much less likely to raise the next fund. So whom are you competing with? You're competing with good funds, right? So each time it's not the same group of funds.
Yeah.
The losers are going away, and you're competing with good people. So that's two. The third thing that I think is tougher on buyout than in venture is in buyout, the sellers are much more likely to just sell to the highest bidder. Whereas in venture, and that's because you're selling 100% of the company in many cases. In in venture, any financing round, you're selling 20% of the company.
Right.
So when you're doing a round in a venture fund, what do you care about? You care about what the 80% you're keeping is worth. And if you think, a Sequoia or a benchmark can help you more than, a Caparino Kaplan, then you're going to take it from the Sequoia or the benchmark. So that's, I think, how you get more persistence on the venture side. The buyout side, you're selling the highest bidder. Maybe you prefer one or the other, but there's much less of looking for the higher value, except maybe lower middle market when people are rolling. There's maybe a little bit
Mhm.
more opportunity for that. But that's why the persistence has been harder to find. I think there's a fourth reason. Everybody's brought the operating capabilities, right? Those used to be differentiating, now they're not. So I think those are, four reasons why the persistence is tougher to find.
Interesting. So you talked about mega fund, you referenced the middle market, lower middle market. When you look at fund size, in your opinion, does fund size, whether on the big or the small end, become an advantage or disadvantage?
So here's my current view, and this is a going forward view. And again, I have a 50% chance of being right, so take it with a grain of salt. The the mega funds now have, you know, there's a question of what's better for the GP and what's better for the LPs. Okay, so I'm gonna have an LP perspective. From a GP perspective, size is usually good because you make more money,
Right.
right? If you have a $20 billion fund and you have a 15% gross return, only 15, you're going to make more money than $1 billion fund with a 30% return because it's just, the 20 times
Yeah.
more money, with fees and whatever is just going to dominate. So for the GP, size is great, and that's why so many have gotten big. From the LP's perspective, over the last vintages over this, period, post GFC, and in particular, 26 post 2016, the megas have underperformed. I think lower middle market has done best, middle market's done better, and the megas have underperformed. And I think there are a few reasons for that. Number one, they're a little more leveraged, so they got hit more by the increase in interest rates. Number two, it's harder to exit, right? Once you buy something, as a mega, you can't sell it to another PE firm.
Right.
Your exit is, you got two exits. Largely, you have strategics who, and they were a bit circumscribed under the Biden administration antitrust. That's a
Right.
little better now, or go public. And going public, A is hard, and B, it takes a long time to exit. So the larger deals have a bit of a headwind in terms of being able to exit, and the lower middle market can sell to the middle market. So the exits are, and they've done a lot, or the CVs, or whatever. There are a lot of different exit options for the smaller deals. And as you get bigger, it gets harder and harder. And I don't see that changing, which is why the megas are now moving down. They all have smaller funds, which may again create more competition down there. So again, it's all, the hard part about this is where there are good returns, money comes in, and there's competition. And so going forward, at some point there shouldn't be excess returns. And the thing that's the reason I don't, number one, I don't make predictions, is that, I was wrong for a long time because I thought in the late 90s, there's no way this can continue.
Right.
So I told people in the late 90s, don't, private equity is not going to be great. I was wrong. Then I think in 06 or 07, I said, there's too much money, don't invest. In 06, 07, was just around the S&P, maybe a little bit more, but it wasn't great. But then I was wrong. Post GFC, it was great for a while. So the private equity investors are very, very smart, and they figure things out. And so betting against them, I'm not sure I do that, but it's more competitive. So you got those forces going on. I think it's harder at the larger, for the larger fund sizes.
A segue to that, and this is a more recent development, but the market now is becoming more open to retail investors. That brings a whole other dynamic. So theoretically, you would think the big get bigger, the smaller funds get bigger because they have access to a greater amount of retail investors. How do you see that aspect with retail investors now getting into private equity? How do you see that impacting the industry in general? Does it change the way private equity operates? Does it change the way they evaluate a company or a CEO? What are your thoughts on that?
So there, there are a lot of things to talk about. So the first order piece is, you're bringing more money in, and the question is there a supply of companies to buy at good returns, right? That's the question. And so if too much money comes in, the returns are going to go down. So that's can you put the money to work? And I've talked to some GPs who are taking retail money who have that question, like, I hope we can put it to work. So that's number one, a question. Number two is, so is you put it to work, there are deals, then what additional fees are there? So the couple of vehicles I've looked at in the private wealth channel, you're adding fees on top of the 2 and 20 or 1.5 and 20. And so again, that puts downward pressure on the net return, which is something I worry about, and particularly for the 401ks. You want to, if you're putting your pension fund there, you want to, figure out, is there some vehicle where you get those fees down? Because I think if you don't get the fees down, it's not sure, if there's a 2% or 3% alpha and the fees are 2% or 3%, well, it's gone. So that is something I would be very cognizant of if I were a retail investor thinking of going in that direction. And then, the third thing to worry about is, that kind of invites regulation if something goes wrong. So it's, and the PE firms are going there because that's where the money is, and they want more fees, and that's, the GP side. But I think there are those three negatives on the LP side, and time will tell. Again, it's one of those things where the the GPs have been very resourceful and smart over time, and we'll see.
Yeah, it's interesting. I never would have thought there'd be that much focus on retail investing because it was never allowed, but it seems to be going in that direction. So it'll be interesting. Those are interesting points, particularly on the regulation side. I hadn't thought about that. But much like anything else, when it impacts a pension or a retirement, it would be ripe for regulation. Okay. Last topic, and maybe we'll wrap it up with one broad question. You've done a lot of research around successful CEOs and the traits of successful CEOs. And clearly that's an area many firms invest by picking the CEO or betting on the CEO. So without getting into a ton of detail, because this is a big area of your research, but what are some broad factors that differentiate good CEOs from other executives, or great CEOs from average CEOs? You've spent a lot of time researching this, and I've heard you speak on this topic, but a few tidbits would be very, very helpful.
Good. And you want me to speak for 2 minutes, not 2 hours? Okay. So, over time, I've had access to very good data on CEO assessments. I did a bunch of work with GH Smart. I've done some work with a very large, well-known search firm. And when you look at who becomes a CEO, they tend to have the following characteristics. They are, or let's start with candidates, then who becomes a CEO, then who succeeds. So candidates tend to be talented. They tend to be execution oriented versus, call it, agreeable or interpersonal, which surprises people. They tend to be charismatic, and they tend to be creative, strategic. So those are sort of the four characteristics that make you a candidate. Then who gets hired? The ones who get hired are a little more on the agreeable side versus they start out high execution. The ones who get hired are a little bit less high execution and more on the agreeable interpersonal. Charisma goes up. So they tend to be a little bit more charismatic than the average candidate and a little bit more agreeable than the average candidate. Then you see who succeeds. And what succeeds is the execution. It's not the agreeable. The agreeable is irrelevant. So and creative strategic. That turns out to work. Charisma doesn't seem to matter. So the bottom line on that research is just be careful of hiring the CEO candidate you like who doesn't execute. And I guarantee you it happens. And then people are a little hesitant to hire the execution person if he or she's a little rough around the edges. But that is much more likely to be successful than the agreeable person who doesn't execute.
That's great. There are many lessons there, and listening to you, and again, I've heard you speak at YPO seminar and other outlets, but those are really good lessons even for our business when we look to hire those types of traits are things that we evaluate, and it's not just at the CEO level because I think it holds true for other levels as well of either upper management or partners or even some senior staff.
I think that is absolutely true.
All right. Well, Steve, it's been a pleasure. Thank you so much. Your wealth of knowledge and perspective on private equity is quite amazing, and I've
Yeah.
always learned something in speaking to you. So we're happy to be a sponsor of the conference. We'll see you soon out there, and thank you very much for spending the time today. Appreciate it.
You're very welcome. Thank you for being a sponsor. It's an awesome conference, and it'll be great to see you. And this was fun.